basically, you have seen us talking about multifamily as well, and then over time, we're adding different segments of the portfolio. Those are the standard 6 broad buckets. We rolled up as much as we can to have a healthy, meaningful size. So we have retail, office, industrial, multifamily, hospitality, and special purposes. From the massive side perspective, we invested in industrial and retail, multifamily, and some special purposes are coming in line. I rolled up land under the special purposes in my mind. We don't do hotels and we are not office investors. But on the other side, we're looking for an office space to buy. We have a couple of offers out. We'll see how that pans out. So tonight, we'll talk about the triple net really biasing towards retail and industrial space. And the negotiating terms, we'll talk about that. That will probably cut across both from retail and industrial and office, but we're really biased towards the retail and the industrial space. As usual, please participate. Drop any questions you may have as we go through this slide. We have lots of time at the back end to do Q&A, and so please engage as you can. And if you're driving, be careful. We need you to stay with us for a long time. So again, feel free to chime in as well as you go. For us, massive side, what we talk about is that us as the investors, both LP side and on the GP side, we should build a portfolio very similar to the equity market that we have. That means we need to invest across a lot of asset segments, some triple net, some multifamily, some new development, and land, because they all are different. Their return may be more or less similar type at the end of the day, but how they get to the returns and they are different. And I tried to simplify as much as I could have. Typically, triple net, we go after a steady cash flow, no upside. I mean, less of a volatility. Multifamily, it's going to ramp up. Then you have depreciation, new developments, usually shorter timeline and higher return. And land have the lowest downside if you do it right. Right. So land. So if I say we want to build a portfolio that has some CD, some dividend paying, and some dividend plus growth, you can look at that way. Land, if you do it right, it should behave like a CD. So a triple net should behave, not CD, I would say like a bond type of thing. That's your land. Triple net could be a CD, gives you a certain amount of return, or it's a dividend stock, right? Multifamily should be growth / slightly dividend, and new development purely growth, right? So you can mimic those portfolios. As you do those blended portfolio, what happens, different time of the market, a different type of asset will go through different cycles. So your portfolio will be a mixed bag of a bunch of cycles. So it's going to behave, pretty steady state, right? Again, depending on your life cycle, depending on your expectation, depending on your long-term growth, all of us, we always encourage you to deploy your capital across multiple asset segments. Then on top of that, you add more segmentation in a portfolio by investing in asset class A, B, and C. Sorry, it's typo. So class A has a different characteristics versus a B versus a C. So if you put triple net in asset segments and asset classes side by side, then you get to pick and choose how you build your portfolio. Then if you want to further de-risk, we always say across geographical locations. Every state behaves differently. Every city will behave differently. And so if you have, and I'll give an example within the Texas, right? Houston will behave differently than Austin. Austin will behave differently than the DFW area. So understanding the project, the asset class, and then the location, as an investor, you'll have a blended approach so you can build your portfolio as you go, right? If hypothetically, someone says, I love Florida and I invest in Miami, it's great. If they would have invested only in Miami, they'll be in a really tough time for next a couple of years or so. But on that note, if you could invest in Florida and Texas, right, and Carolinas, 1/3 of your portfolio will take an impact, but guess what? 2/3 is still working. So that those 2/3 will pull the weight for the 1/3, and when the 1/3 comes back out, you're in a better spot, right? So blended approach is always good. And our philosophy from the massive side is the same way. And that's how we invest. And that's how we bring projects to investors. That's, so you can blend, you can have a blended approach, right? So over time, with massive side, we started from the multifamily angle, and then we add land. Now we added new construction, which is new development. So going back to what Trevor was talking about, we compete in two different asset classes. One, on the new construction, because we own the construction company. That's our way into the Class A. So we can build anything with the metal frame, which is also why we're buying land and for new construction as well. On the other side, we compete on the multifamily value add, and from the operational side, we have our ways of doing the operations. So between those two, we have some specialty, some leverage. So when you walk into the market space, we can create more value. Okay, so let's look at the differences, right? So typically the lease expense matrix or the retail and industrial, I took a common matrix. What we said, if I put all the rental and the cost together, how would that look like, right? So I will start on the top right side, the full service gross. I will change the terminology with the way we collect. So think about single family, right? What happens in a single family? If I have a house, or if you have a, I know, as you have a house, the tenant gets you one check. That is it, and that is your full service gross amount. They give you one check, and from there, if plumbing something happens, janitorial, we pay. Utilities, we'll pay if you have a tenant, right? Depending on how it goes. The maintenance or something breaks, we pay. Taxes and insurance, we pay, right? So that's the highest expense. Or think about apartments, right? If I have an all bills paid apartment, they will cut us one check and we'll pay for everything. And then if you go to industrial space or your commercial space, this is where the modified gross amount, the industrial gross, and the triple net happens. Typically, the further you go left, your asset classes will go up. That means if you have a Class A commercial asset, typically that's absolute triple net, which is, and you got the Chipotle on a Class A location. The Chipotle will give you the base rent. They're going to pay you back for the plumbing fixtures. They're going to pay you for the utilities. They're going to pay you back the maintenance at the parking spot, and they're going to pay for taxes and insurance. So if we are the landlord, we have a Class A location, that is probably the absolute triple net. And then, so that means your operational ratio is very minimal. You can calculate how much cash you're going to be end up having every single month. You can forecast what time with of the month you'll get the check, and with the high certainty, right? On a Class A, typically you get restaurants or chains, a business, so their job is to make the money and pay you on time. It's not individual earning, it's a business earning, right? So that's how it goes from left to right. If you look at industrial space, they not that many will do absolute triple net unless it's a huge industrial, but you have a version of the modified gross amount. If you do a Class C location or B minus location, you'll typically get this version of it. We have a couple of them, and then by industrial gross, a flex space and things like that will be right here, right? So it's a blended. So another way from moving forward, if you want to buy or invest in any asset, you could say, hey, I would like some Class A assets where Chipotle is paying me the bill, and I can forecast my portfolio cash flow. On the other side, I got some multifamilies. There's some upside and downside. So as an investor, you can always look at this matrix and then invest accordingly across all asset classes as you go. So in a simplistic time, single family and multifamily, it's in that bucket, which is your gross rent right there. And we pay most of this stuff. And flex, industrial, and retail, mostly it's here. And the retail is most of the time, it's on the absolute triple net basis. So from operation side, if you want to be operational lean, it's right here. And if on operation heavy, it's right here. But then value side perspective, triple net gets you the least amount of value because it's a risk adjusted return. More work we do, more the margin, less work we do, less the margin, which is also why typically on a larger Class A asset, institutional money comes in. They said, hey, I'm here for 10 years and I'm trying to solve for 8 to 10%. I don't want to fight the battle, let somebody else fight the battle, but I just want to get a steady state return. And I'm solving for 8 to 10%, right? But I'm solving for 10 years. If I buy something was built in 2024, it's not going to go down. It's going to stay up and down, whatever it is, but still Class A to become a Class B, it takes decades, right? That's why you'll see on the multifamily side, on the industrial side, on the retail side, Class A's are dominated by those industrial players. But for us, we came in, we said, look, we cannot compete on the dollar return, but we can compete on the construction cost return, and we can simulate similar type of return for our investors who are not institutional, right? So that's how we kind of played it, and that's how we are building our and strength and the technical skills as you go. So let me take it down a little bit more, down to a side-by-side level. It's supposed to be one step at a time, but I made a mistake. This slide, okay. So what I did was I took land, triple net, multifamily, and single family in a little bit more, qualitative way. I put the risk level, management, income, and ideal for. Again, I tried to put the polarization a little bit more so you get to understand. On the land side, if we buy the land without knowing the technical details, it's high risk because it doesn't have an immediate cash flow. Most of my portfolio on my, that we park, as I do land banking. We have a land acquisition company, and that's what we do. But when we buy land, we have a bunch of technical things. We take a look at it and we buy it and we mitigate as much of a risk as we can. That's because it doesn't cash flow, which is also why most of our land purchase that we do, it's an all equity purchase, less of a loan, and with the buy time, 2 to 3 years of hold time as you go. And when we buy, we have 10 to 15% margin from the market. So if something were to happen, we can weather the land as you go, right? So you can dial up and down as you go. But on the retail side, it's extremely high risk. When you get into a land just for land without any direct plan and you take a debt on it, that becomes very problematic. Less management, and it's appreciation future development when you go sell it, and ideal for speculative investors from the retail side. But from massive side, we buy completely off market. Uh, Almost 99.99% of our land deals came off market. We haven't bought anything from the market that where we didn't know. We don't know what to do with it. So we buy land as a land with a long-term hold as you go. On the triple net side, it's a low risk, low volatility. That's because it has predictable cash flow, right? During the COVID time, we bought around 8 warehouses there. I'll give an example. When we bought the 8 warehouses, 5 of them were industrial warehouses. They smelled, they look dirty, it is stinky. You don't want to go in with the white shirts or white clothes on, because by the time you come out, it's going to be all, chances are it's going to be black. But we bought it with a smile on our face and hi-fi. The reason behind we bought it is because when we buy triple net asset, we're not really buying the cash flow. We're really buying the confidence level of the company or the tenant revenue. So when we bought those 5 assets, those are all industrial, specialty valve manufacturing. Those are in Pasadena and Baytown, and supplying to the refineries. And those manufacturing companies, there's one manufacturing company, the owner sold the company but kept the businesses, and then they sold us so kept the real estate, and we bought the real estate from him. And when we looked at the revenue of the company, they were in black during the COVID because, number one, if there's a valve leak, they got to fix. So they have a captive audience. And the second thing was the design of the valve cannot be outsourced. Those are custom made, so they cannot offshore it out to anybody else. Hence, it's a solid business. When we saw those 2, we bought them the whole portfolio, and we exited. Now, the problem with the triple net was when we bought it, rent escalation was 2%. When the inflation happened, more than 2%, we sold them all. At least we saw it coming. So we sold 4 of them. 1 of them, we still have it. And from the other 3, we exited 2 of them. That means even though triple net is a great asset to buy, you need to look at it from the macroeconomics perspective, the worst inflation coming in, how you are parking the cash flow, and what type of tenants you're bringing in. So it's a great asset class. We love it. Management is very minimal. Tenant covers everything. This is one of our most I would say least amount of work adjusted return. Every month on the 3rd, money will show up in a bank account. I didn't know who was cutting the check. I didn't know who was wiring the money. All I knew, the accountant, and she was wiring the fund, and that was it. All 5 of them all together. Income is consistent, lower growth potential, which is absolutely true because you're growing by 2% or you're growing by 3%. It's fixed. And that's a 5-year lease or 7 years lease, anything like that. And when the negotiating happen, it's a very sophisticated negotiating. I'll walk you guys through a little bit down the way. This is fantastic for passive investors and predictability. Then you have the multifamily. Has moderate risk, mostly because the higher management involvement. It requires active management or third-party management service. It is very active management, right? That will go sideways if you're not on top of that. Beautiful thing is it has cash flow, appreciation, and depreciation. We can, one of the beautiful thing, one of the reason we got into the apartment, if we think about it, it is because whenever inflation happen or whenever the economy changes, you need products with pricing power. That means you can change the prices as the market changes. That means you can increase or decrease the rent as the market increases and decreases. Multifamily gets you that, triple net doesn't. So if you want to hedge against the inflation, you get into multifamily. And if you think inflation is done, you're looking for a steady state, you deploy some fund in the triple net asset. So even though they look good, if you don't have a, and at least as an investment perspective, you need to have a macroeconomic position. From there, you deploy your fund in the real estate. Gets technical, we love it. Between the multifamily and triple net, everything has a time and a place for it. And now we're out of the inflation. Triple net makes a lot of sense, and the multifamily gives us the pricing power. So you should have both. So it offers cash flow appreciation, depreciation, and then if you're looking for cash flow appreciation and tax advantage, that's the way to go. That's some of the depreciation you get in the triple net assets as well. It's a little bit less. In other words, um, in today's market, and this year, if you invest $100,000 in apartments, you'd get roughly $70,000 of write-offs, 70, 75. If you invest the same $100,000 in triple net, you'll get probably $50,000 write-off, because triple net is just a metal building, some offices, less bathrooms, less things to write off, right? And the lastly, the single family properties. It's one of the highest risk. Sorry, it's one of the highest risks that we have, because if you have a single family, if it doesn't, if the tenant is out, it's 100% no income, right? It's active management as you go. It's a lower cash flow compared to multifamily, but potential of a strong appreciation in some markets. And but we love the single family because single family is the best confidence booster. And also, we don't talk about it much single family, because if you have if you work and you have a single family, if 1 month or 2 months or 3 months doesn't pan out, it's maybe $600,000, $700,000. It's a hit, but from your total income level, it's not a lot of hit. So that's why typically you'll see whenever you have tenants and whenever you have a single family, it hurts, but you don't talk about it much, right? That because the impact is not grand. But if you have 10 houses and all of them are empty, that's problematic, right? And also single family, usually it's a one loan per unit. So if you got 10 houses, chances are you took 10 loans, right? And then over time, you got to roll up and get some portfolio loans as you go. So risk adjusted, I put left to right, what I felt like, and also intensity of management perspective, I put left to right. So you get to see that where from the passive side also you get the least amount of risk to the most amount of risk. So you can kind of take a look at it. So if you're LP passive, look at those investment and return type from left to right. If you're active investors, then go left to right as well. And again, we live in a world, it's all about risk adjusted return. So less risk to take, usually less returns you get, right? So it's a choice that we make, and where do we deploy fund, and how do we balance our portfolio as we go. Okay. All right. So let's get into some examples, right? Triple net projects. So I took this screenshot from online. I was looking for some terms that we negotiate with the for the triple net asset. So those are some of the buckets that you have to negotiate through. So I'll use an example of a Class A triple net negotiating, right? So we have a base rent. On top of the base rent, there could be a additional rent clause. That means we have a property in Fayette, Texas. It's a mixed use. First floor is retail. We have 4 retail shops, and second and third are the residential. Classic example for it. One of the tenants of our building, it's a good Mexican restaurant. And one of the coolest thing about Mexican restaurant, that thing opens 4 days a week, 5 days a week, and opens at 2 p.m., closes at 11 p.m. And they make money. they have lines through it. So we have a clause in there that after a certain amount of revenue, we get a percentage of the revenue because of the location that you have, and that negotiating rent you have to have, right? So if you go to, I will, let me use Chipotle as a nationwide tenant, they will not give it to you. Versus you have a up and coming or somebody's second shop or third shop, somebody's first shop, they're really passionate about it, you can negotiate in. So depending on who is your leasing broker, depending on who places that type of tenant, you can negotiate the additional rent, right? So that's there. Demolition clause, that's coming in once that tenant gets out. Who pays for the demo? Because every single tenant got their own way of setting it up. Then the parking lot is limited. We allocate something, but sometimes we don't have enough parking. Then how do you get the priority of it, right? Then option to renew. And when you get the option to renew, how do you get the lease rate? So I'll give an example within the Fate as well. It's a downtown destination. We don't have enough parking spot per building. So cities ask to share with us, plus the other free parking as well. On that note, what we have to do, we have to take the parking lots that are owned by us and we allocate it out. And we have a couple of slots open. If someone wants to get those slots extra for the weekend, you pay for it and we do the parking. So that becomes a thing, right? Versus we have some other spaces when you have a tenant comes in with a lot of traffic, then how would that look like? Right around my house, they have a retail strip center, and one of the tenant is an ambulance service provider. And I know the owner and the way he negotiated, because ambulances are big and that's a bulky vehicle that you do that. And if you'd have 10 ambulances parked, it just doesn't look good. So his clause was the ambulances cannot come to the parking spot before 10 p.m. and they got to leave before 7 a.m. So that's how you negotiate the parking spot as you go. Renewal, it's an option to renewal. It's a 2 years, 3 years, 5 years, 10 years. You want to hedge your bet against it or for it, depending on where you at. Most of the time, what we do is 5 years, and if not 3 years. We don't do anything less than 3 years and no more than 5 years, because the inflation and the market changes too much. Then we kind of go from there. And also renewal depends on the strength of the tenant's revenue, right? If the tenant is not making money, we see the report, and then we know they're going to come back and terminate, or we know they're going to go negotiate. And also we have to kind of keep an eye on that one. And one of the things we pay attention to the renewal or option to renewal and the additional rent, it's the increase in taxes and insurances. One of the beautiful thing about triple net is taxes and insurance are being paid, but not by us directly. There's a buffer between us and the state and the feds that they are the tenants, right? What I call it is 2 times a year we get heart failure, which is April and September. April for taxes, September for insurances, right? So between those 2 months, we can navigate through it if you do it the right way. List rates, it's an art. It's an art, and this is a roll up your sleeves and negotiate. Oftentimes, the local franchise owners or local business owners, they may not see how you get to the rate, so you have to work them through to the rate. I'll give an example. One of the KD locations that we have, we are going rate, it's $35 a square foot. With the $35, you also get a $12 square foot. That's your triple net, which is the additional thing. So you'll be end up paying $47 square foot. $47 square foot, it is okay for a restaurant to pay when they're up and running. But when they're not up and running, it takes 3 months for them to open a restaurant, 4 months for them to open a restaurant, and 2-3 months to get a hold of the process. So there's 6 or 7 months out for the $47. But we can always negotiate by saying that, hey, give me $47 today, and I'll have you 3 months, and I'll know or step down or some $10 a month or something like that. So you can work your way up. So list rate, it's a purely negotiating. Every dollar counts. So we'll negotiate up front. If you can get it, we'll negotiate on the renewal. If you can get it, we'll negotiate on the parking, additional rent. If you can get it, we'll negotiate on the tenant improvements. So every single thing is negotiating. And then the exclusive clause. Exclusive clause. We have locations. I'll show you some example where Pizza Hut is there. When Pizza Hut is there, they will tell you within a certain proximity, I can't have any other restaurants, or in that particular location, I cannot have anything that provides that kind of a food service or anything like that. So they will negotiate hard versus if you get Sissy's Pizza, you can put another sandwich shop right next door. Even though both of them will sell sandwiches, they don't have the clause that hard, right? And the other one is leasing terms. Terms are very important, right? And the tenant improvement is the biggest cost. We do new development. On the new development, the TI is expensive, and you got to have a TI team to execute it for you. So as a developer, as a construction team, we could say, hey, let's say hypothetically, the lease rate is $35, and for tenant improvement that we want, it's here $40 a square foot, right? But then the project I'm slipped a little bit. We need to get some costs out of the system. So what we'll do, we'll say, hey, tenant, it's $30, $40 a square foot. That's your tenant improvement. But since we have the construction crew, we'll be end up finishing at $30. As we have a $10 of savings, that goes back to the project, and we do that. And this is also something we can negotiate, right? And then we have the fixturing period, how long it takes for us to get the project, get the TI, and and put everything together. So all in all, it's not a just I come in, I pay $35 and I run a background check and a credit check of the residential tenant. That report will tell us what the credit quality looks like for the tenant, and then we'll do some comms. Based on the comms, I put a price, and that is it. It has a lot more negotiating, which is also why the specialty team, a residential broker, love you guys cannot negotiate a listing term. A listing agent, who lists just the commercial assets, they are not designed to it. And typically, a leasing agent on the commercial side, this is all they do. They know how to negotiate. They know how to bring a right tenant at the right spot. I'll give you an example. If you have an empty spot where you're building a building and you have 4 tenants, you have a choice between a pizza shop and a Mexican restaurant and an Italian restaurant there. Question is, who do you bring in? And that's where specialty comes in. If I'm a specialty broker, then we'll say, you know what? Oftentimes I list a bunch of other places, and I know there are 3 other pizza store went in, the 2 other Italian restaurant went in. This place is a good for a Mexican restaurant, right? So we're going to put that in. Versus we have some specialty data company. We come in, what they do a zip code based search. Based on the source, they could tell us, hey, based on the economic driver of the location and the Google searches, they are looking for a pizza shop. They're not looking for Italian shops, restaurant. And they are maybe half of them are looking for Mexican restaurant. So depending on if you have those 3 options, higher priority is get the pizza store first, then the Mexican, and then the Italian, right? So there's some data-centric negotiating and placement of the tenant into that as an art. Right. So all in all, there's a local know-how on the leasing. Loan type is mostly recourse team, the TI crew and leasing agent and an accountant. And that's the team that you need once you own an asset, right? So that's where we are.